Hi! In this video, I'm going to look at the power of compound interest and how it's a really useful weapon in the armory of nearly all successful investors. And then following on from that, I'm going to look at 3 other useful investment lessons that are linked to the power of compound interest. So let's have a look at what compound interest actually is. Let's say you've got £1,000 and you stick it in a bank account and you're getting interest of 10% a year. I know that's way higher than what you get now, but it's good for the example. So we're getting £1,000, 10%. After a year, that £1,000 has grown to £1,100. Our cash gain is £100. In the second year, our £1,100 has grown to £1,210. So our cash gain now is bigger. It's £110. And that's because we're getting interest on the capital, but also interest on the interest. And it goes on like this. When we get to year 4, our £1,000 has grown to £1,464. And that's because we're getting interest on the original capital, but we're also getting interest on the interest and interest on the interest on the interest and interest here as well. We're getting all this interest compounding up, growing and giving us the power of compound interest. And if we kept this money in the bank account for many more years, growing at 10% a year, the cash gains that you'd make each year would snowball up and you'd start to build a really sizable savings pot. And obviously this doesn't just apply to savings, it also implies to investing as well. So let's imagine you've got £1,000 which you're going to invest. If you want to use the power of compound interest to get a really good return, it makes sense to start investing young. So if we start young, we've got £1,000 and we're getting 5% a year, annual gain, that's on top of inflation. So it's a better return than it sounds. After 10 years of having that money in the stock market, we'd have £1,628, a cash gain of just over £600. If we then leave the money in the stock market for another 10 years, after 20 years, our money's grown to £2,653. The cash gain is over £1,000. And we're still getting, remember, a 5% gain a year on top of inflation. That's actually turning into quite a good return on our money. If we stay in there for 30 years, our money grows now to £4,300. Our cash gain is well over £1,600. We can only start to get these sort of snowballing investment gains if we can stay invested for a long time. And obviously, if you can start investing younger, you're more likely to get that kind of long-running snowball. I wasn't investing when I was 25. I wish I had been. I suspect most people watching this video are over 25 too, but if you know some younger people, tell them to find any spare cash they can and start investing then and benefit from compound interest. Now, one crucial point though, getting this kind of 5% return above inflation, if you're going to get that kind of return, or indeed a better return, you're almost certainly going to have to reinvest your dividends from the shares you invest in. Academic studies have shown that around 2/3 of the long-term return from stock markets comes from dividends, not from growing share prices. So let's just do a really long-term example here. Let's imagine you put £100 into a UK index tracker fund in 1945. I know there were no tracker funds then, but you get the idea. Put £100 into the stock market in 1945 and leave it there till 2010. Very long time horizon, but it makes the point. If you didn't reinvest the dividends over this 65-year period, your £100 would turn into £255. Now again, that's a real gain, it's on top of inflation. It's okay, but it's nothing special, nothing to get excited about. But if you reinvested your dividends over that 65-year period, your £100 would turn into £4,370. It's a vastly better return, all because you reinvested your dividends. So if you've got money in the stock market, if you possibly can, reinvest, let the power of compound interest really kick in and deliver some great investment gains. My final point is that just small changes in the annual return can make big differences over the long term. When we looked at these figures, we were assuming an annual 5% return on top of inflation. And that, after 30 years, our £1,000 had become £4,300. Well, let's imagine instead of a 5% return, we had a 6% annual return. Suddenly that £4,300 would be £5,743, just because you were getting 1 extra percent a year. So it really pays to find the investments that will deliver you the best return without taking too much risk over a long period. And it also pays to keep the costs down, because that's another way just to bump up the annual return by 1 or maybe 2%, just getting the costs down. So that's 3 lessons we've learned following on from the power of compound interest. Small differences in return make a big difference. Reinvest your dividends and start young. And that's the best way to utilize the power of compound interest. I hope you found this video useful. I'll be back with another one soon. And if you want to see some more of the videos we've done here at Money Week, they're not all available on the main YouTube site. You come over to moneyweek.com/YouTube, and you'll find lots more videos in our archive that you can't see on the YouTube site. So I do hope you come over to the Money Week site and have a look around. Until next week, good luck with your investing.